Welcome to this screencast on an introduction to accounting, the accounting equation and the balance sheets. So what are we going to look at? Well, we're first of all going to look at the reasons for keeping accurate accounting records, and then we'll look at what the accounting equation is and what makes up the accounting equation, and that'll be followed by definitions of the terms assets, liabilities and capital, also known as equity. That'll be in part one. In part two, we'll look at how we can use that information to prepare simple balance sheets of a business using the accounting equation. So, reasons for keeping accurate accounting records. Why would a business need to do this? Well, this is assessed regularly in ACM 1. It's usually one of the first couple of questions. Firstly, to see if a business has made a profit or a loss, and we do that by preparing something called an income statement, and we'll come to that in due course. Secondly, to look at the solvency of the business, whether the business can pay its debts, and we do that through the balance sheet, which is what we're going to look at today. Thirdly, to forecast the future and compare those forecasts against actual performance. So if we think we're going to make a certain amount of sales, have we made those sales in reality? And if we haven't, what can we do to make sure that we do? Fourthly, to meet legal requirements. HM Revenue and Customs, HMRC, require us to submit financial statements so they can check we're paying the correct amount of tax. So we need to keep records in order to be able to do that. Then, to support applications for finance, again, we need financial statements to give to the bank if we ask for a loan as part of a business plan. And so we need accurate accounting records to make sure those financial statements are correct. And lastly, to reduce chances of fraud by ensuring that transactions are recorded properly. If money is leaving our bank account and we don't spot it, then eventually we're going to run out of cash. So the accounting equation, what is it? Well, the accounting equation is at the heart of the balance sheet, which is what we're looking at today, but also double entry bookkeeping, which we'll come on to shortly. And it states that assets equal capital, also known as equity, plus liabilities. Assets equal capital plus liabilities. Now we're going to define those terms. Firstly, assets. An asset is something the business owns or is owed. Therefore, is something valuable to the business. And there are two types. Firstly, the non-current assets, and secondly, current assets. In terms of what those are, firstly, the non-current assets are things that the business will keep and use in the business for more than 1 year. So typical examples would be property, vehicles, equipment. We don't intend to sell those things, we're going to keep them and use them to run the business. Whereas current assets, these are things that either are cash or can easily be turned into cash. For example, our inventory or stock, the thing that we intend to sell to customers, we're going to sell that and get cash. Money in the bank, you can put your card in the wall in the cash till and get cash out. And then finally, cash itself at the end. On the other side of the accounting equation, we find liabilities. So liabilities, what are they? Well, a liability is really the opposite of an asset. It's something the business owes to somebody else, normally outside the business. Again, there are two types. They are current liabilities and non-current liabilities. In terms of what those are, current liabilities, remember this is money we owe, we have to pay that money within the next 12 months. So they're short-term debts. Typical examples would be trade payables. These are suppliers who give us credit, give us time to pay for the goods that we bought from them. Secondly, short-term loans that have to be paid back within the next 12 months. And finally, a bank overdraft. So if we spend more money than we've got in the bank, we go overdrawn, we owe that money back to the bank. And the bank can ask that to be repaid at any time. So it could be a very, very short-term liability indeed. Secondly, non-current liabilities. These are payable in more than 12 months' time. So they're longer-term debts. Longer-term loans, 2 years or more, but also mortgages. So if we buy property, we owe the money, we have to borrow the money to be able to afford to buy it. That loan is going to be secured on the property that we bought, and therefore if we fail to repay, the bank or whoever's lent us the money can sell that asset off, those premises off, in order to get their money back. The last thing on the accounting equation is the capital, also known as equity. This is what the owner invests in the business. This is what the owner's put in to start the business off, plus anything that he or she has put in afterwards. And in fact, we can calculate what this is using the accounting equation in a slightly rearranged form. The original version was assets equals capital plus liabilities, but we can rearrange that to find the capital. In other words, the capital is the assets minus the liabilities. It's the difference between the things we own, the assets, and the things we owe, the liabilities. That all then plugs into the balance sheet. So the balance sheet is actually a financial health check of the business. It can show us the business's financial position. Is it in a good financial position? Is it healthy? Or is it in a poor financial position? Secondly, it's like a snapshot of the business. It tells us where the business is at a particular point in time. Usually, for our purposes, that's at the end of the year. Every business has a year end, which it prepares its financial statements for, and the balance sheet is one of those financial statements. And then thirdly, it's also a guide to the solvency of the business. As we mentioned earlier, it can tell us whether the business can pay its debts or not. If it can pay its debts, the business is likely to survive and be what we call a going concern. If it can't pay its debts, it's likely to go out of business, and therefore everyone's going to lose their money. That's the end of part 1. That's introducing the various terms. In part 2, we'll look at a simple balance sheet example and see how we can use the accounting equation to solve that.